sort of guess, okay, it's 5 times income, blah, blah, blah. But maybe it's not in your situation because maybe you don't know that actually because you've got the school fees, you're not going to be 5 times income, you know? Or maybe because you've got a credit card that's 20,000, you can't do 5 times income.
Hey, welcome back to the channel. Today's video is another part from the conversation I had with a friend of mine, Ganesh, who is a mortgage advisor. The whole conversation addresses various questions that every person just like you and I go through when we begin to think about buying a property. I'll be uploading the full video soon and you can find it in the playlist up here or in the description down below. But this video today is just a snippet where I ask Ganesh tips on what a first-time home buyer should think about before making the biggest purchase in their life. So let's jump straight into the conversation. What's a step-by-step kind of guide that you would kind of say to a first-time buyer if they were looking to kind of purchase a new house? Like what are the kind of steps that they need to go through?
I think the first thing is speak to a broker or speak to a bank.
So even before kind of like looking at properties, thinking about like what you're doing, just
absolutely
talk to a broker straight away.
Absolutely. Think of it like this, right? If you're shopping for a wallet, or it's like, okay, wallet's a really bad example, but let's say you're trying to buy some shoes for a night out, right? You don't go there not knowing what you're going to spend.
Yeah.
You know, if you're going to spend £500, then you'll go to a certain shop.
Yeah.
If you're going to spend £30, you're getting TK Maxx. You know what I mean? So it's one of those things. Like I find it crazy, like why people go and view properties if they have no idea what they can afford. Okay.
So then I guess on that front is when's that time? Because like for me, I have no plans to move out this flat for at least maybe like a year, maybe 2 years.
Okay.
But I'm probably looking at other properties just to see what's in the market. Should I be talking to a mortgage advisor now at this stage, just early stages, just to get a feel for what I should be doing?
Absolutely. What a mortgage advisor does, you know, well, a good one hopefully, is it's about planning with you. Okay. You know, because these things don't happen overnight. You know, if say for example, let's take you as an example, right? So you're saying you want to move. And I'm guessing it's for something that's maybe you want a bigger place, okay? So the first thing you need to understand is how much is that bigger place going to cost you right now? Because if we work it out now, then we've got a pretty good idea of what it's going to be in a year's time. Because your circumstances, whether you're going to keep this place or you're not going to keep this place, you know, we can discuss all those factors, right? But the beauty is we can plan together what is realistic. Yeah. Because you would open up with me and you'll say, look, in a year's time, I'm hoping that my salary will be this. My wife will be this. You know, we might be having a child, so we're a bit worried about this. Yeah. There's just so many different things. If you walked with me and talked with me about it, then we can plan together. So I would say there's, you know, I speak to, I love, you know, sometimes you could argue it's a waste of time for me, right? Because you're speaking so early on and nothing's going to happen for like a year, 2 years. But those are the best customers because they're the ones that get the most value because you're not just having one meeting and then doing a mortgage. You might, with the way I operate, it's not just one meeting and then the mortgage meeting. It's one meeting and then if we have to have a second meeting and a third meeting and a fourth meeting, you know, as long as the food's good, no, but you know, we'll have as many meetings as we need to, whilst until you're comfortable, and ultimately, my job is to study the finances. So you know, it's good for you to do it, and there's a lot of articles, and you could sort of guess, okay, it's 5 times income, blah blah blah. But maybe it's not in your situation because maybe you don't know that actually because you've got the school fees, you're not going to be 5 times income, you know? Or maybe because you've got a credit card that's 20,000, you can't do 5 times income. And that's my job to then educate you. Or let's say, for example, we know we've got 60 grand's equity in this place and the place that you need to buy, you need an £80,000 deposit. So then we both know that in between now and the next time we talk, you need to have 20,000 for more and you need to hope this has gone up, and you need to clear some of the debt that we've just discussed. So then we're just catching up every 6 months casually. And those are the customers I'd say who benefit the most. So it's a great question because a lot of people just assume that they just sort of come right at the end. But really, what they do at the beginning is they just go online. You know, most people, to be honest with you, they're not stupid. They do spend a lot of time and they do check things before they go shopping. So it's not that whole reference to TK Maxx it's not how it happens, obviously. But you're never going to get the level of detail that you'd get from a broker.
It's not going to be personalized to you.
No.
You're going to be looking at someone else's experience when you go online. There's obviously various different types of mortgages out there. What are they? And like, can you give us a breakdown of the different styles there are?
Yeah. So I'd say historically there was like a lot of different types of mortgages, you know. There was like capped, variable, tracker, fixed, you know. Now really there's, I'd say two products really, fixed and tracker, okay. Fixed rate depends on sort of how many years you want to do it. So there's an initial benefit period. So even though your mortgage might be 25 years, I'm just using 25 years as an example, but even though it might be 25 years, it's fixed for 2 years, 3 years, or 5 years.
Okay.
Sometimes 10 years, okay? Or there's a tracker. So the tracker, it tracks the base rate. So at the moment, obviously, you can imagine base rate's amazing.
Yeah.
So if you got your tracker, I don't know, 5 years ago, you are very lucky, you know? Yeah. So if it's 1% plus base, it'll be 1.1 at the moment, yeah? So that normally comes in a 2 year as well, sometimes a 3, or a lifetime is very common. So some people just like to be on a tracker for the lifetime. I'll do tracker first. The reason why a lot of people go for tracker is, one, obviously you can try and save money if the rates go down. But more importantly, it gives you a bit more flexibility. So you can overpay unlimited amounts on your mortgage. So if you're an investment banker and your basic salary is 60,000, but you get bonuses of like 150,000, right? Which is very common in certain industries. You can overpay as much as you want of that mortgage. So if you imagine that pay slip, you're, I don't know, earning 90,000 or 80,000. If you can just pay a massive lump sum off your mortgage, and that's what you'd like to do, and not go on holiday, then you know you want that flexibility. Whereas with a fixed rate, most fixed rates you can only overpay by 10%.
Yeah. So I guess the benefits of that obviously is that if you can pay a lump sum, a significant amount, even like a small amount, it's taking years off the number of years that
you're paying less interest effectively. You know?
So you're saving yourselves thousands of pounds just by putting a lump sum more into it.
Absolutely.
So that at the end of your mortgage, let's say it's 25 years, now it's all of a sudden 20 years.
Absolutely.
And so that's the main thing around
that's
that, right?
the main thing. That's why people do overpayments, you know, and I'm a massive fan of overpayment. As sad as it sounds, I don't want anyone to have a mortgage. You know, I don't think I want to have a mortgage. But it's about sort of, you know, tailoring it in the right way. Fixed rate, the other obvious answer is it gives you a fixed amount that you're paying for 2 years or 3 years or 5 years. Whereas with the tracker, it tracks the base rate. So you never know if the base rate goes up, then suddenly you're going from paying £1,200 a month to £1,300, you know? Whereas with the fixed, you know exactly what you're paying, you can budget, especially if it's two of you and you're both sharing the bills, it's just a lot easier to manage, you know?
When you're looking at like first time buyers and things like that, there are schemes that the government has. Now, I've heard things where people say like, it's all a scam. And that you shouldn't go for them. In the long run, you're going to end up losing money, or like the government's going to take your property, and all sorts of stuff.
There's a lot of paranoid people.
So I think, can you give us like an idea of the different schemes that are available at the moment? Because obviously it keeps changing and stuff like that. But
I think it's hard because when you get something, I mean, the way it's sort of sold, if you know what I mean, and the way it's marketed, is like you're sort of getting something for free, you know, and you know. There's no such thing as a free lunch, you know. So this is where people get a bit cynical about the government and the schemes, and you know why, you know. But ultimately, they're amazing, you know. Most people, including myself, wouldn't have got on the ladder without some of these schemes. So I got on the ladder by using shared ownership. You know, if I hadn't done that, there is absolutely no way I'd be in the property I'm in now. And yes, I've been lucky, property prices have gone up, and obviously I've done good in my career and been able to buy the share out and things like that. So there's a lot of different factors, but the point is there is no way I would have got on the ladder.
So I guess on that front, what's shared ownership?
So shared ownership is where you are buying a percentage of the property. So if it's a flat that's valued at 200,000, you're buying a share of 25%. So in that case, it would be 50,000, of which you then put a deposit down. So there are shared ownership schemes where you only have to put 5% down, and then you're paying a percentage of whatever's remaining. Now the 75% that you don't own is charged at a reduced rent. So where the open market rent for that property might be 1,200, because you own a quarter of it, it's reduced quite significantly to maybe 600.
So you're paying a mortgage on the amount that you've borrowed plus a little bit more on rent. Okay. So I guess, like you said, I think we kind of sidestepped from that step-to-step process. What are those step-to-step processes of like a first-time buyer? So like obviously we've got to the fact that you've gone to a mortgage advisor. You've done.
So that's the first thing I was saying, right? And after that, I would say, I mean, another good thing, just a quick tip to throw in, is get a credit report. When you do a credit check, what's good about it is it gives you a breakdown of exactly what's outstanding on your loans, how good you are with your money, how, you know, and showing a broker that is always helpful. So that's a quick tip there. But you get the mortgage, you speak to the mortgage advisor, and hopefully obtain what's called as a mortgage decision in principle or mortgage in principle. Then what you would do is you'd go and look for the property, and you can also, while you're researching the mortgage advisor, research your solicitor as well, right? Because you need to choose which one you want to, who's going to act on your behalf. Then you found the property, contact the estate agent will be the first to know because they're the ones that have negotiated the deal, unless it's a private sale. And then your mortgage advisor would submit the application, but they need to know the access details, i.e. the estate agent's details, the full property address, and the full solicitor's details. Everything else, all the documents around your income and things like that, the mortgage advisor should have access to it because they wouldn't have got to this point without it. Yeah. And then it's a process of the solicitor starts carrying out their work. They start sending out searches on the property. The seller's solicitor also has, the seller also has a solicitor. So you've got these two solicitors sort of doing it for you. It's not the buyer talking to the vendor, you know? And they will be asking, okay, well, we think there's these things that we're a bit worried about. Do you have anything to say about that? And then they will come back with, no, this is fine. We're going to satisfy this. And then once they've satisfied all their inquiries, the searches are all good, Canna's got his mortgage offer over to you, then, well, you know, you start locking in an exchange date and a completion date. But if it was that simple, then I'd do all of it. But but that's literally, you know, the process in a nutshell. Yeah.
Okay. Yeah. So I guess once you do get that final stage, like, I'm going to be putting down that and getting that mortgage, what's included in that? So like, is that everything? You're done. You've got the house. That what's actually included? Because obviously there's stamp duty. There's all these other stuff. There's
from the solicitor's point of view.
I guess from a first-time buyer's view. The costs that are involved.
Okay,
like,
that's good.
I'm not just thinking about the mortgage here, am I?
No, there's lots of
one
things.
aspect, right?
So mortgage is the reason why I think everyone sort of makes such a big thing about it is it's the biggest cost, right? Because it's a monthly cost and monthly commitment, right? But then you've got things like life insurance, you know, buildings insurance, contents insurance. These are things that are designed to make sure that you are protected and cool in your house, basically. You know, if something goes wrong, you've got some sort of insurance to protect you. If one of you were to die, then you don't have to worry because the mortgage is going to be paid off. Especially if you have children, you have families, like, it's very important as you know, it's a hard subject to talk about, but especially now with COVID and things, but, you know, cancer rates have gone up. It's just one of those things that's happening a lot at the moment. So, and it's becoming younger, sadly, you know. So these things have devastating impacts to families, right? So having a percentage of your income, like you spending that on protecting it, is a sensible thing to do, you know? And that's something that we would discuss. Then you've got, in terms of overall costs, you've got your stamp duty. That's probably the biggest cost. If you're a first-time buyer, up to 300,000, there's no stamp duty, which is brilliant. But otherwise, you have that as a cost, especially if you're moving. Then solicitor fees.
What if you're a first-time buyer, but maybe your partner isn't.
Then unfortunately, you can't piggyback off it. No.
Thanks, Kana, for a great conversation. I for sure learned a lot having a conversation with Kana. I'm sure you must have learned at least one thing, if not lots more from this video. Remember, every person's situation is unique. So if you are thinking about buying a new property, regardless of when, as Kana mentioned, any time is always going to be a great time, as TSK Mortgages will be able to help you get your dream home. And also, they can help you plan towards getting there as well. So check them out in the link in the description down below, or head over to Kana's Instagram page at tsk.mortgages to find out more. If you like this video, make sure you check out the bite-sized videos in the playlist down there, and check out Kana at TSK Mortgages here. And while you're at it, go and follow Kana on his Instagram and subscribe to this channel. Smash the like button and comment down below and share with your friends and family. Peace and love to all of you. See you in the next video. Bye.